One of the most common questions I get from executives and high earning professionals, it's some version of, Dan, how do I know if we can afford to buy the lake house without blowing up our retirement plan? Or maybe it's, we want to take that extended trip to Europe, upgrade the cars, and help the kids with a down payment, but we also want to scale back our work in 5 to 10 years. Can we do both? And here's what I tell them. The answer isn't found in some rule of thumb or back of the napkin math. The answer is found in building a customized financial plan that maps your resources to your goals and shows you what's actually achievable based on your specific situation. Not generic advice, not guesswork, a real plan. And today I'm going to walk you through exactly how we do this for our clients. I'll share the exact planning software that we use to build custom financial plans and show you how to think about funding a major lifestyle milestone like a vacation home while still staying on track for the retirement you want. Now, I want to be clear about something. This isn't about sacrifice, and it's not about choosing between living well today and securing your future. It's about understanding the trade-offs, modeling the scenarios, and making intentional decisions that align your money with the life that you actually want to live. The situation I'm walking through today, it's hypothetical, but it's modeled after real conversations that we have with clients every single week. The numbers, the goals, and the tension between spending now and planning for later. This is what real financial planning looks like for busy professionals managing complex financial lives. We've found that most people with substantial income and solid savings don't have a spending problem. They have a clarity problem. So in this video, we're going to solve for that. And if you want to run similar scenarios for your own situation, I've included a link in the description below that will give you hands-on access to a streamlined version of this exact planning software. You'll be able to plug in your own numbers, test different scenarios, and see what's actually possible for you. All right, let's dive in. Okay, so now we're in our planning software, and as you can see, today's client is Jim and Pam Halpert from one of my favorite shows, The Office. And you can see here that Jim is 48, Pam is 46, and they have 2 kids, Philip, who's 11, and Cece, who's 8. Now, in order to build out their financial plan and see if they're on track to accomplish their goals, we need to enter accurate data about their current situation. So the first thing that we're going to look at is their pre-retirement living expenses. So on average, how much are they spending a month? And in this situation, they've got living expenses that average around $14,500 a month. Next, let's take a look at their income. Jim has a salary of $300,000 and an average annual bonus of $60,000. Pam has a salary of $215,000 and no annual bonus. And then later on, we'll talk about optimizing and modeling out their Social Security. Next, we'll take a look at savings. So currently, both Jim and Pam are contributing 4% to their company's 401k plan. And if you take a look within what we call these cards, you can see that they also each have a company match where the company matches 100% up to 4% of their contribution. So the system is modeling in those matches. Additionally, they are contributing $5,000 a year per child into their respective 529 plans. Now let's look at their net worth, which is comprised of their assets and liabilities. So you can see here they've got some money in the bank, they've got investment accounts, they've got property valued at $1.9 million, of which there's a little over $900,000 left on the loan. So if we click here and go into their investments, you can see here that Jim and Pam both have 401ks. They've got the 529 plans that we talked about earlier for CC and Philip. Jim has an IRA as well as a Roth. Pam has a Roth, and then they've got a joint taxable account. So that makes up their current investment accounts. Here's the details of their mortgage. Here was the origination amount. They bought in 2020 during COVID, so good time to buy. Here's the interest rate and their monthly payment. So the system is going to assume that they have this monthly mortgage payment for 30 years from the origination date. Here's what we assume that the property is worth, along with their property taxes and annual insurance along with annual maintenance on the home. The property taxes, the insurance, and the maintenance, we will not assume that that will go away with the mortgage because those will continue as long as they own this home. And we can set the system to sell the home at a certain date, but in this case, we're not going to do that. Now let's go through my favorite part of the financial planning process, the goals. So here's what we're going to model out for Jim and Pam. They would like to retire in 10 years when Jim is 58 and Pam is 56. And that syncs up well because that's when Cece, their youngest, will go off to college. They assume retirement expenses of about $12,500 a month, which is slightly less than what they're paying today. Obviously, with the kids out of the house, we expect the expenses to go down. But they'd like to fully fund Philip and Cece's education. So if we click on these cards, you can see here we've got a few different options. We can look at different types of universities and look at national averages. Or if we know the specific colleges that we want to model out, we can actually pull those universities in. But in this case, we're looking at private, nonprofit, 4-year on-campus universities, which in most cases for undergrad is going to be the most expensive route. And we're not going to model in any scholarship grants or student borrowing. We could do that, and that would impact the plan. But in this case, Jim and Pam have decided they'd like to fully fund their kids' educations. Now, they'd also like to buy a vacation home. They love South Carolina, and their goal is to purchase a home there in 2029. So we're going to model out what that purchase looks like. We give, what we expect the purchase price to be, everything from the down payment to what the loan's going to look like to annual insurance, maintenance. If they choose to rent it out, we can model that in here as well. In this case, we're not going to do it. We're just going to use it specifically for their enjoyment purposes. Then, in addition to their retirement monthly expenses, they'd also like to plan for a specific travel budget in retirement. They haven't had the time to travel while they're working, and they'd really like to make up for lost time there in retirement. So we modeled out an annual travel budget of $40,000. We decided that we believe their cash reserve need is about $75,000. And then they'd also like to start giving to the Dunder Mifflin charity in about 5 years of about $10,000 a year. Lastly, we have their annual health costs and their long-term care costs, which is calculated by the system. So these are the goals that we're going to try and optimize a plan for and see if we can make it work. And what this screen shows is the current tax allocation of their investment portfolio. And one of the biggest determining factors of your success in retirement and your overall ability to grow and keep wealth is how you allocate your investments from a tax perspective. So you can see in their situation, they've got 1.375 in taxable assets, over 1.7 in tax deferred, and just about 115 in tax free. And you can see the overall composition in this pie chart here. So one of our objectives for them is going to be to build in and further diversify the tax treatment of their portfolio. So in order to do that and to help them accomplish their overall goals, we've built in several recommendations and strategies into the plan. So we continue to have Jim and Pam contributing 4% to their traditional 401k. But in addition, we're also going to model in and recommend that they each contribute to what's called a backdoor Roth IRA. Now, they each make too much to contribute to a traditional Roth IRA, but their 401k allows them to contribute after-tax dollars and then convert those dollars to a Roth, thus building up the tax-free bucket that we showed you earlier they're a little bit light on today. Additionally, we're going to recommend that they contribute and save about $10,000 a year into their joint taxable account, and that's going to be used for the vacation home as well as funding the kids' education. Now, if you come over to the right column, you can see that the optimal Social Security strategy for them is to take at age 70. And then if you go down the list here, as far as the debt strategy is concerned, we didn't change anything there because the only debt that they have is their mortgage. But we did come up with an education proposal, which essentially has them funding the kids' education through a combination of the 529 plans and their taxable accounts, as well as a tax strategy and a retirement spending strategy, which is really critical to their long-term success, and we'll show you now. Their tax strategy is comprised of 3 levers. The asset location strategy, which is essentially how do they invest their savings into which taxable buckets pre-retirement. Their withdrawal strategy, so which accounts do they pull from in retirement, in what sequence and how much in each year, and then Roth conversions. So in this case, we are recommending Roth conversions when they retire. We're not going to go through all of the specifics around each of these strategies now, but we will have those coming in a later video. But by optimizing those three levers, as you can see here, the system shows that we're able to save them over $3 million. So they're going to pay over $3 million less in taxes because we're optimizing in those three areas. And I tell every prospective client that I speak with, this is where most money gets given away to the government and the IRS by not having a tax-efficient retirement, asset location, distribution or income, Roth conversion strategy. But by optimizing those, you can really save a lot over the long haul. Now, this is their cash flow report, which is critical to their financial plan and will become a key component of their investment plan, as we use a framework called life-driven investing, which is built off of the cash flow report. So you can see here that they've got cash inflows, they've got cash outflows, and then they've got net flows, which we'll focus on here. And you can see that in most years leading up to retirement, they have net flows, which we're investing into the taxable account, as we discussed earlier. But you can see here that there is a year where there's negative flows. And what year is that? Well, that's 2029, because that's the year that we're going to model in the vacation home purchase. So we are modeling that into the cash flow and expecting that in 2029. Then in 2035, they retire. And now, instead of saving and having predominantly net flows, they're going to have net outflows. And the outflows are going to vary year to year, but early on in retirement, they become greater. So we need to model out and ensure that their plan will hold up during the distribution years. Now, in order to see if this plan will stand up, the system does Monte Carlo simulations and stress tests, which is 1,000 different historical market simulations evaluating the probability of success, which is defined by there being at least $1 left in the portfolio at the end of the life expectancy, which in this case, we're looking at age 90 for both Jim and Pam, as well as the median portfolio ending value. So you can see here on their current plan, they have a 54% probability of success, and the median portfolio ending value based on this scenario is over 1.2 million. And the recommendations and strategies that we model show up in the proposed plan here, which in this case results in a probability of success of about 24% additional, so from 54% to 78%. And in this case, a median portfolio ending value of about 4.9 million, so roughly 3.7 million more at the end of the proposed plan than in the current plan, which is obviously significant. But we look for a probability of success of at least 80%, and in most cases, we shoot for 85%, because we know that the odds are in our favor to be able to make tweaks along the way if we get to at least 80, but certainly 85% probability of success. So in this situation, we would recommend that the plan needs to change. We need to make some tweaks to the inputs or to the goals in order to allow Jim and Pam to have a higher probability of success. Now, there's a lot of places that we can go to change pieces of the plan to get to a higher probability of success. And that's where the conversation with the client comes in around prioritizing goals. So in this scenario, let's say that Jim and Pam say to us, you know what, we really do want the vacation home, and we really do want that retirement travel. And you know what, we're not willing to budge on paying for CC and Phillips full college tuition. But we do feel like we would be open to working 2 additional years. So instead of retiring in 10 years, model out and let's have us retire in 12 years. And this is what I call scenario planning. So what we're going to do here is simply go in and change Jim's retirement age to 60 and Pam's to 58. Now let's see what that does to our probability of success. Well, look at that. We now have a 90% probability of success on the proposed plan and a significantly higher median portfolio ending value. Now, this would be a plan that we would be comfortable with and move forward on and start to execute. And while pieces of this plan will inevitably change over the years prior to their retirement, Jim and Pam should now feel confident that they can move forward with their goals of funding their kids' tuition, buying the vacation home, and enjoying the retirement they desire. So that's how you actually answer the question, can we afford to buy the lake house and still retire on time? You build the plan, model the scenarios, and make decisions based on real numbers instead of guesswork. And if you want to run this same analysis for your own situation, the link to get access to this planning software is in the description below. Plug in your numbers and see what's actually possible. Now, once you've built your financial plan, the next question is, how do you structure your investments to support it? And that's exactly what we cover in the next video. How to invest for your life, not just returns. I'll show you how we align portfolios with the plan we just built so that your investments are mapped to when you actually need the money. Thanks for watching, and I'll see you in the next one.